Imagine you've invested in glittering gold, tangible, solid. You think you're protected, but 99.9% of people will lose their gold and silver, not because the metals vanish, but because they misunderstand how the system works and what happens next. Well, that will shock you. Most people believe that owning gold and silver is the ultimate form of safety. They picture these metals as immovable, eternal, and immune to the storms of financial systems. On the surface, it feels right, holding something tangible, heavy, and real, unlike paper promises or digital entries in a bank ledger. But the illusion of safety comes from confusing the thing itself with the system in which it exists. The problem isn't gold or silver. The problem is how people interact with them, how they store them, how they buy them, and most importantly, how they misunderstand the rules of the game. And this misunderstanding is why the vast majority will lose. Think about it this way. When you buy gold at retail, you often pay premiums on top of the spot price. That premium can be significant, especially in moments of high demand. People rarely calculate how much of their so-called investment is tied up in dealer fees, minting costs, and market markups. They feel secure because they now possess coins or bars, but what they don't see is that they are already down 10-15% the moment they buy. If gold doesn't rise enough to cover that spread, they've already lost, silently, invisibly, without realizing it. Multiply this across millions of small investors, and you have an entire population believing they're hedged, when in reality they're exposed. Then there's the issue of storage. True safety doesn't come from simply holding the metal. It comes from where and how it's held. If it's in a bank safe deposit box, you are still tied to the banking system. If it's in an ETF, you don't actually hold the metal, you hold a claim. If it's in your home, you face the risks of theft, confiscation, or even natural disasters. And if it's in a vault overseas, your access depends on political stability, border policies, and contract law. What most people call owning gold or silver is, in reality, a fragile arrangement resting on trust in intermediaries, infrastructures, and governments. And that trust is precisely what collapses when things get bad. Beyond logistics, the illusion deepens at the psychological level. People buy gold and silver because they believe it guarantees wealth preservation. They think, as long as I hold this, I'll be fine. But wealth isn't preserved by the object. It's preserved by understanding cycles. In the 1970s, gold soared. In the 1980s and 90s, it stagnated while stocks and bonds multiplied in value. Those who clung blindly to gold through the wrong cycle didn't protect wealth. They eroded it compared to other opportunities. The same is true today. Without context, without timing, without understanding the interplay between credit, growth, inflation, and confidence, owning gold or silver can become a dead weight. It gives emotional comfort, but financial underperformance. There's also the hard reality of manipulation and leverage. Precious metals markets are heavily influenced by futures contracts and derivative trading. The actual physical gold and silver in circulation are dwarfed by paper claims. Prices move not simply on supply and demand, but on liquidity, margin calls, central bank reserves, and institutional positioning. So while an individual imagines their coins or bars as safe, the market reality is that those prices are being pulled by forces far beyond their control. A sudden unwinding in futures can crash prices temporarily, wiping out weak hands. And once again, people who believed they were safe find themselves forced to sell at the worst possible moment. All of this points to the same truth. What people think of as safety is usually an illusion built on incomplete understanding. Safety isn't in the metal itself, it's in knowing how the system functions, how cycles unfold, and how to position yourself intelligently within them. Those who don't recognize this will inevitably be part of the 99. 9% who lose, not because they held the wrong object, but because they played the game without knowing the rules. The tragedy is that their belief in safety blinds them to the very risks they most need to see. Gold occupies a strange dual role in the financial system. On one side, it is treated as the ultimate safe haven, the thing that people run to when the world feels uncertain, when currencies wobble, when geopolitical tensions flare. On the other side, it is still just another asset, subject to cycles, speculation, demand, and opportunity costs. That duality is what makes it both powerful and dangerous, and it's the reason why so many people misinterpret what gold can and cannot do for them. When uncertainty spikes, gold almost always catches a bid. It has thousands of years of history behind it as a store of value. It requires no promise from a government, no credit worthiness from a counterparty. In a world built on paper and digital claims that feels like bedrock, we see it during wars, during inflationary shocks, during moments of monetary instability. Gold rallies because it represents something outside the system, and human psychology instinctively gravitates to it. That part of the story is true, and it explains why investors across the globe, from individuals to central banks, continue to accumulate it. But the other side of the story is less comforting. Gold does not generate income. It does not produce dividends, coupons, or cash flow. When interest rates rise, the opportunity cost of holding gold increases because you are holding a non-yielding asset in a world where safer assets suddenly pay more. This dynamic is what caused long stretches of gold stagnation in the past. Investors forget that while gold may hedge certain risks, it can underperform dramatically in cycles where growth is strong, inflation is under control, and other assets deliver better returns. In those times, capital migrates away from gold, leaving holders sitting on an asset that feels secure but fails to perform. Right now, the global outlook embodies this duality. On one hand, central banks continue to be strong buyers, particularly in emerging markets that want to diversify away from the dollar-dominated system. On the other, forecasts are shifting. If global growth shows resilience and inflation softens, demand for gold could weaken, pulling prices lower even after years of strength. Analysts are already warning of potential downside into late 2025 and 2026. That doesn't make gold irrelevant. It just means the narrative that gold always goes up is overly simplistic and dangerously misleading. The emotional connection to gold is another factor worth examining. People don't just see it as an investment, they see it as protection against chaos. That makes them less rational in how they approach it. They load up heavily when fear is high, often at peak prices, and then abandon it when optimism returns, often near bottoms. This pattern repeats across decades. The irony is that while gold itself is meant to be steady, the human behavior around it introduces extreme volatility. It becomes not just a hedge, but a barometer of fear and greed. And those who fail to recognize that psychology often find themselves whipsawed by the very asset they thought would give them calm. None of this diminishes the importance of gold. It only puts it in perspective. Its role is not as a magic shield, but as a balancing force. It helps hedge against the breakdown of paper assets and the credibility of central banks. But if you lean on it exclusively, without considering the broader environment, you will suffer in the times when growth and stability diminish its appeal. The dual reality is that gold is both indispensable and inadequate. It can preserve, but it can also lag. It can inspire confidence, but it can also generate complacency. The challenge is learning how to navigate that tension. Gold's value comes not from holding it blindly, but from understanding when and why it holds power and when it quietly slips into underperformance. Those who mistake it for an absolute solution will be disappointed. Those who see its dual reality clearly and position accordingly are the few who will harness its strength while avoiding its traps. Silver is one of the most misunderstood assets in the entire financial landscape. It doesn't have the same long history as gold in terms of being the world's reserve store of value, but it has something else. It is both a monetary metal and an industrial necessity. That dual nature is what makes it so volatile, so underappreciated, and so full of potential. The silent storm building in silver is easy to ignore because it doesn't move steadily like gold. It moves in bursts, in waves, often after long periods of disappointment. But those bursts have historically been violent and transformative, rewarding the few who understood the setup while punishing the many who gave up too early. The most important driver of silver's storm today is the structural imbalance between supply and demand. For years now, global demand has consistently exceeded mine production. Recycling adds some relief, but not enough to close the gap. What makes this particularly significant is that a large part of silver's demand isn't optional or speculative, it's industrial. Silver is critical for solar panels, electric vehicles, semiconductors, and a wide range of electronic and medical applications. Unlike gold, which is primarily stored and hoarded, silver gets consumed. Once it's used in a tiny layer of a solar cell or a component, it is not easily recoverable. This means that every year more and more silver is disappearing into products while supply struggles to keep pace. This structural deficit has already persisted for multiple consecutive years, and history tells us that when you run these kinds of imbalances for too long, the adjustment eventually comes violently through price. But the adjustment doesn't happen smoothly. Markets are slow to price in structural shifts until a trigger event forces recognition. That's why silver has this tendency to lull people into complacency, hovering in ranges that look uneventful, only to explode higher in a matter of months when awareness catches up to reality. The moves in 1980, in 2011, and in shorter bursts since then all follow this pattern. What builds slowly and silently in the background suddenly expresses itself as a storm. Adding to this setup is the current gold-silver ratio. Historically, that ratio has averaged somewhere around 60 to 70 ounces of silver per ounce of gold. Today, it has been sitting near extremes of 90 to 100. Whenever the ratio has reached those stretched levels, silver has tended to play catch-up. That catch-up isn't gentle, it's often dramatic, with silver outperforming gold by multiples in the following cycle. That kind of asymmetry makes silver one of the most compelling opportunities for those who can stomach volatility. Yet most investors ignore it, or worse, they view its underperformance relative to gold as a reason to dismiss it entirely. They miss the fact that this underperformance is often the precursor to its strongest rallies. Another part of the storm is the psychology around silver. It doesn't have the same respect as gold among central banks or sovereign wealth funds. It's often viewed as the poor man's gold. That perception creates neglect, But neglect is precisely what sets up outsized opportunities. When something essential is ignored long enough, it becomes mispriced. And when the world suddenly realizes its importance, whether through a surge in renewable energy investment, a geopolitical shock that disrupts mining, or a wave of investors piling in, it can reprice at lightning speed. The silent storm is not about predicting the exact week or month when silver will move. It's about understanding that the conditions for a major move are building quietly in the background and will eventually collide with reality. Investors who dismiss it because it hasn't broken out yet are making the same mistake people always make when facing slow, building imbalances. They assume quiet means safe, but quiet in this case is simply the calm before the acceleration. Silver is not an easy asset to hold. It demands patience, resilience, and a recognition that volatility is the price you pay for asymmetry. But the reward for enduring that storm can be profound. Those who understand the structural deficits, the industrial demand, and the ratio signals see that this is not just another commodity. It is a compressed spring, one that gets tighter every year, and when it finally releases, it will shock nearly everyone who wasn't prepared. Timing is one of the most misunderstood aspects of investing, and nowhere is this clearer than in the relationship between gold and silver. People often focus on the absolute price of each metal, but the deeper insight comes from looking at them relative to one another. The gold to silver ratio has been a remarkably powerful signal across history, and yet it is ignored by the majority of investors. This ratio doesn't just tell you where silver stands compared to gold. It gives a window into the broader psychology of markets, the flow of capital, and the cycles of fear and confidence that underpin them. When the ratio is low, it means silver has been strong relative to gold. That often happens in periods when speculative enthusiasm runs high, because silver has a more industrial and volatile character. When the ratio is high, it means silver has lagged behind, often ignored or even dismissed. Historically, when the ratio reaches extreme highs, levels like 90, 95, or even 100, it has tended to mark the point where silver is undervalued relative to gold. And what usually follows is not just a small correction, but a rebalancing that sees silver surge dramatically, while gold either rises moderately or moves sideways. The logic behind this is rooted in how markets correct imbalances. Gold and silver are tethered by both history and function. They are both seen as monetary metals, stores of value in different forms. When one stretches too far away from the other, it reflects a distortion, an overextension of confidence in one relative to neglect of the other. These distortions don't last indefinitely. They resolve when investors recognize the mispricing and capital rotates. That recognition doesn't come gradually. It comes suddenly, often sparked by a catalyst like a geopolitical shock, a policy change, or a technological surge in demand. The ratio, in other words, is like a stretched rubber band. The more it stretches, the more powerful the snapback tends to be. Right now, the band is stretched. The ratio has been hovering near historic extremes. In the past, these levels have not been sustainable. In 2011, for example, when silver exploded to nearly $50 an ounce, the move came after years of silver lagging and the ratio sitting at elevated levels. Investors who paid attention to that imbalance positioned themselves ahead of one of the most dramatic commodity rallies of the decade. Those who ignored it were shocked at how fast silver repriced. But timing through ratio is not about predicting exact days or weeks. It is about understanding cycles and probabilities. When the ratio is at extremes, the probability of silver outperforming gold over the next cycle rises sharply. That doesn't mean there won't be volatility along the way. Silver is notorious for whipsaws. But it does mean that if you step back and look at the broader arc, silver is likely to be the more rewarding asset when the pendulum swings back. The challenge for most investors is patience. Ratios can stay distorted longer than people expect. The temptation is to give up when silver underperforms year after year. Yet that very discouragement is what sets the stage for the rebalancing. Markets don't reward the majority. They reward those who can see what the majority ignores. Right now, the majority sees silver as irrelevant compared to gold. That neglect is the opportunity. Another layer of insight comes from looking at the macro backdrop. If global growth slows, central banks keep buying gold, and industrial demand for silver keeps rising. The ratio is likely to correct not just because silver catches up, but because gold holds steady while silver is pulled higher by necessity. Energy transition, renewable infrastructure, and technology demand are not optional trends. They are locked into the trajectory of global development. That creates a unique alignment where both psychology and fundamentals point in the same direction. Timing through ratio is not a perfect science. Nothing in markets ever is, but it is one of the most powerful signals of when asymmetry is at its peak. Those who understand it are not speculating blindly. They are aligning themselves with historical patterns, structural imbalances, and human behavior that repeats across cycles. The extremes we are seeing today are not the signs of stability. They are the quiet warnings of a coming adjustment, and when that adjustment hits, it rarely does so gradually. It arrives as a storm, and only those who read the signal beforehand are prepared to benefit from it. Hope is a powerful force in markets, but by itself it is dangerous. It makes people believe that the asset they hold will always rise, that the story they tell themselves about its future is already written. Silver will soar because demand is rising. Gold will protect because it always has. These are hopeful narratives, and while they may contain truth, they can also blind. Humility is what tempers hope. It's the recognition that the market does not move according to personal conviction, that cycles do not bend to individual desire, and that even the strongest assets can disappoint those who become overconfident. The balance between hope and humility is not just an emotional discipline. It is the difference between surviving cycles and being destroyed by them. Consider what happens in bubbles. Prices rise, people grow more certain, and narratives harden. Every rally convinces more participants that the trend is unstoppable. In the world of precious metals, this has happened many times. When gold surged to nearly $2.00 in 2011, or when silver pushed toward $1.50, people believed the move was only the beginning. Commentators claimed the dollar was collapsing, central banks had lost control, and the metals were destined for the moon. Yet what followed was a decade-long decline in silver and years of underperformance in gold. Those who anchored only on hope were crushed, not because the long-term role of these metals disappeared, but because cycles shifted and their conviction blinded them to reality. Humility comes from remembering that no asset is immune from drawdowns. Gold and silver can fall sharply even when the long-term fundamentals are strong. They can stagnate for years even when the logic for higher prices seems obvious. Manipulation, policy shifts, stronger alternatives, or simply changing cycles can keep them suppressed far longer than most people can remain patient. Without humility, investors overexpose themselves, put too much weight on one outcome, and fail to manage risk. That is how even those who understood the big picture end up losing everything. At the same time, abandoning hope altogether is equally dangerous. If you only focus on risks, you miss opportunities. The reality is that these metals do provide essential functions. They protect against monetary debasement. They diversify portfolios. Silver especially has industrial tailwinds that are undeniable. Hope is what allows you to hold through volatility, to wait out the lulls, to endure the frustration that comes before the storm. But the kind of hope that is grounded in understanding rather than fantasy is what truly serves investors. It's the belief that while no cycle is permanent, positioning intelligently over time pays off, even if timing is imperfect. The balance is to combine hope with humility. Hold the conviction that silver's deficits and gold's reserve role matter, but pair it with the humility to accept that rallies can crash, bubbles can burst, and timing can betray you. That balance leads to diversification. It leads to risk management. It leads to the willingness to step back when markets become overheated, and the courage to step in when they are undervalued and ignored. Those who master this balance do not get swept away by euphoria or destroyed by despair. They ride the cycles instead of being broken by them. Right now, it is easy to lean too heavily on hope. Forecasts of silver shortages and gold safe. Haven's strength feed a narrative that feels bulletproof. But humility reminds us that corrections always follow excess. Prices can fall, sometimes violently, even in strong long-term trends. Recognizing that possibility, preparing for it, and surviving it is what separates those who merely believe from those who endure. In the end, the real edge in precious metals, or in any market, is not knowledge alone. Many people know the facts. The edge is the discipline to balance belief with restraint, to hope for the upside while protecting against the downside, to never assume that what feels obvious today will remain true tomorrow. This is not pessimism, it is wisdom. Those who fail to balance hope with humility are the ones who will eventually be forced out, often at the worst possible time. Those who succeed will be the rare few who keep their wealth through storms and across cycles, when the majority lose.